Hi everyone, thanks very much for joining this session. Firstly, just some housekeeping to let you know that this session will be recorded and there will also be a Q&A function available throughout the webinar as well. Just also a quick note to acknowledge that the session is also supported by ICAEW Hong Kong, so the Institute of Chartered Accountants. And there's also various members on the call, so we would just like to thank them for the support. So moving into the agenda and a quick introduction. So I'm Anna Coburn, a principal consultant based in our Singapore office. And I'm also joined by my colleague Alison Snellen, a principal consultant based in our Hong Kong office. I should also note at this stage that this is a webinar of part one. Part two will be held next week at the same time, focusing on physical risks. But today we'll be focusing on how to quantify the financial impacts of risks and opportunities, with particular emphasis on transition risks and opportunities. We'll first of all provide some context on the requirements linked to IFRS, and then move into how companies should quantify financial impacts at a high level, finishing off with a couple of worked examples. And if we have time at the end, we'll do a Q&A. But please note that any questions that are not answered, we'll be collating these and following up on these after the webinar as well. Perhaps before we jump into the content, just to note that if you're new to climate risk, climate reporting, or scenario analysis, we have recently delivered webinars on all of these topics covering both IFRS S2, so for Singapore, Hong Kong and New Zealand, and ASRS in Australia as well. So please get in touch or have a look on our website for some further information as well. I'll very briefly just provide an overview of SLR. So we work with clients in a number of different sectors, and Alison and I are in the strategic advisory team, but we do have 45 technical services, from ecologists to energy engineers, that implement the strategies that we develop and turn the advice that we give into on-the-ground action. We are a global consultancy, but we have many offices here in APAC. And if you do want to know a bit more about the services that we offer, please do reach out. But for now, I'll get into the main content of the webinar. So in this first section, we'll cover the context and the requirements. So it's becoming well known that climate risk is increasingly being recognised as one of the most material financial issues facing organisations. And a report recently released by the World Economic Forum highlights the growing threat of the climate crisis, and that on business profitability, but also supply chains and social stability as well. An estimate suggests that companies can expect fixed asset losses of up to 10% of EBITDA per year due to climate volatility over the next 2 decades. And as we're focusing on transition risks, it should be noted that for some industries under low emission scenarios, these risks can be much more significant than the physical risks as well, so should be thoroughly considered. So as tangible business risks rise, companies need to make better informed decisions that safeguard both their business and corporate supply chains as well. So as a result, numerous market-led initiatives have been established, with efforts recently harmonised by IFRS S2 standard from ISSB. And just as a bit of a recap, these climate-related financial disclosures were created to provide decision-useful information for investors on how to understand climate change impacts on an organisation and how the organisation is responding as well. And in terms of what these standards seek to achieve is a common language for sustainability-related disclosures, so creating a global baseline, driving comparability, and also quite key is the integration with financial reporting as well. So IFRS S2 is the standard that's used for mandatory climate-related disclosures used in different regions around APAC. It requires companies to provide more detailed information information on climate-related risks and opportunities. The standard is composed of 4 pillars, which we've got on the left-hand side of the screen. So governance, strategy, risk management, and metrics and targets. There's a lot of detailed requirements within the standard, but we've pulled out some of the requirements as a summary for both business information and financial information as well for the context of this webinar. So in terms of some of that business information, looking at what the impacts will be on the business model and value chain of these risks and opportunities. So considering things like geographical area, facilities, and the types of assets as well. And then also thinking about the planned strategic response to address these climate-related risks and opportunities. So thinking about your mitigation and adaptation efforts as well. And all of this is particularly important when we're looking at risks and opportunities, but also quantifying them as well. And in terms of links to financial information, so some of the reporting requirements looking at the effect on the reporting period, so including if there's any expected adjustments to the financial statement, and then anticipated changes over short, medium, and long term, also considering things like strategy for investment, disposal plans, or strategic investment as well. However, it should be noted that there are some instances in which companies may not have to report financial impact information associated with risks and opportunities. So the first one on here is commercially sensitive information, and this can be omitted. And the definition of this is found in IFRS S1. It might pertain to certain opportunities, where, example, you might not want to disclose the potential financial magnitude of, say, a new product or additional revenue streams to competitors. And then the second point on here, the disclosure of financial information where methodology is uncertain or the impacts are not separately identifiable. So for example, if we're looking at perhaps a transition risk of customer pressure or new product opportunities, it might be a lot more difficult to put a financial figure against, as there might not be scenario data that exists, or the methodologies might be quite highly uncertain and not as robust, so might not be as useful to stakeholders. So now we've provided some context on the regulatory requirements and provided a high-level understanding of the purpose of disclosures. We'll go into how organisations should quantify financial impacts of risks and opportunities. So at a very high level, we've provided an overview of the whole process from initially identifying risks and opportunities right to the financial quantification. And as I mentioned, if you're quite new to scenario analysis or identifying climate risks and opportunities, then please do look at some of the other webinars we have on the website that dive into this in some more detail. But as a high-level recap on the process, so starting at stage 1, right at the beginning, companies will build the capabilities to conduct scenario analysis, confirming things like time horizons and climate scenarios, and perhaps facilitating capacity building within the organisation, so within different business units, considering how scenario analysis will be used, and a bit of an introduction to the reporting requirements as well. And at the end of this stage 1, companies will have a long list of potential risks and opportunities. And then moving from stage 1 to stage 2, so moving from a long list to a more condensed list for further analysis. So this is where we would assess risks and opportunities across scenarios and time horizons, and carry out quite a robust scoring. So considering things like magnitude, likelihood, and vulnerability. And this is where companies would start to consider some of the climate data, scenario data, and policy research to evidence the scoring and show how you've shortened this long list. We'll consider stage 3 slightly in the next couple of slides, but essentially this is moving from your scored risks and opportunities to the short list that you are looking to quantify the financial impact of. And then in stage 4, again, we'll cover this more in the rest of the webinar, but calculating the financial impact of material risks over climate scenarios and time horizons. And finishing up with the final stage of integrating risks and opportunities into business strategy. So considering the adaptation and mitigation strategy and how this is integrated throughout the business. It's maybe worth noting that shown on the screen, we have a kind of linear process, but we know that companies might start to consider how risks are impacting their business and integrate it into the business at different stages. Similarly, they might disclose at different stages throughout this process as well. So in terms of where companies are now, from our experience in regions where there have already been some form of climate regulation in place, so mainly stemming from TCFD, many companies have already identified a long list of risks and opportunities and have an understanding of climate scenario analysis. A lot of companies have also assessed these risks and opportunities over the climate scenarios and also over time horizons, and might have started to consider some of those mitigation and adaptation plans. However, it should be noted there is varying level of detail to which companies have perhaps assessed and scored these risks and opportunities, but this is quite an important part for if companies are looking at assurance as well. Nonetheless, the outcome of this end stage or the first few stages is having a condensed list of risks and opportunities that are likely to be most material to the business, with a strong understanding of where in the business these will arise, and also against the time horizons and scenarios that will be most prominent. So now we have a condensed list of risks to consider for financial quantification. I'll just hand over to Alison to start going through the process.
Thanks. Great. So now to more get onto the how of the financial quantification. So what you'll see on the slide is our suggested approach for the quantification of risks and opportunities. So starting at the beginning, you'll see transition risk. So first identifying which transition risk you want to quantify and having a proper understanding of how this risk impacts your business, because this could also be in multiple ways and in different areas of the business. Next is financial impact. So here you want to understand what are the financial impacts of this risk that's materializing. Could it be, loss of revenue? Could it be increase of operating costs? And then particularly you'll need to then link it to a line item inside your forward-looking financial business plan in order to continue with the quantification. Then next we have methodology. So this is also what we sometimes call developing the calculation pathway. So here we want to determine what's the appropriate approach in order to quantify this risk. So for the quantification of transition risks, typically you'll be using 3 types of data. You'll be using financial data from the business plan. You'll be using climate data from a third-party scenario data set, and then also you'll be using operational data. And we'll get into some more of this detail in some of the next slides as well. But this step in developing the calculation pathways is particularly where, as an organization, you'll want to meet with multiple functions to really understand how you determine some of the key assumptions that are going to feed into this calculation pathway. And then next we have data collection. So in the earlier step, determining the calculation approach and then finding out what data you're going to need. And this can often be a challenging step, and organizations often need to use proxies in order to fill some of the data gaps, but we'll also get onto more of that later. And then finally is analyze. So this step is really about taking all of that data, inputting it into your model to perform the calculation. And most organizations are using Excel to do this. And then finally, as a last step, for analyze, you should be doing, a stand back, thinking about, looking at the results, thinking, do they make sense? Are they trending the right way? Is this what we expected? Do the values look sensible? For example, comparing that financial impact to perhaps your gross profit or your revenue. If we go on to the next slide. So as I mentioned on the previous slide, that there are three main types of data that you're going to be using in your calculation pathway. So the first is the financial data. So transition risks will have potentially a number of flow-on financial impacts. So for example, operating costs, maybe there could be a policy risk that you need to do emissions reporting or scenario analysis. That's going to result in operating costs for your business. Perhaps it could be direct costs, like these would be things like carbon pricing, or perhaps you could also have reduced demand or for products and sales. And this could perhaps be a result of a reputational risk materializing. And then you'll also have operational data. So this will likely be, fairly intuitive depending on the risk that you're quantifying. So some of the examples that we have here, so GHG emissions. So obviously you're going to need this for something like carbon pricing, but maybe for a less obvious transition risk that you might be quantifying, perhaps you're looking at reputation and you want to look at, what your forecasted GHG emissions are going to be in comparison to the market in order to determine, how the market might perceive you. Also, we have things like product volumes or revenue breakdowns. So perhaps you'll need this in order to understand when you've identified a revenue impact of a transition risk. And then also what you'll see at the kind of end of some of these examples is we've stated future projections. And this is actually a really critical component actually for both the operational data and then also the financial data. So the scenario analysis that you'll be doing is likely to extend over kind of a longer term time horizon, maybe 2050, 2060, and hardly any businesses are typically forecasting over that period. So as an organization, you're also going to need to come to a consensus about what your growth percentages you're going to apply to your operational data, also to your financial data. And sometimes you'll also be modifying this depending on the climate scenario that you're using. And then finally, the third type of data is the climate scenario data, which you're going to source from a third party, some of the different organizations we've listed there. And this is going to tell you how, external variables are going to differ under climate scenarios. So these could be things like shadow carbon price. It could be, demand for electric vehicles versus, internal combustion engines, or it could be macroeconomic data like household wealth or perhaps interest rates. Then going on to the next slide. So as I was mentioning, sometimes it can be quite difficult to determine your calculation pathway, particularly for transition risks, because sometimes it's hard to assume how these risks or opportunities could affect your business. So actually, I had a client when I was in London, and they were in the media space. And for example, they knew that reputational risk from climate change was their biggest risk, although they couldn't really agree internally on an appropriate methodology in order to determine how a poor reputation from climate would affect their revenue. They couldn't really see like a clear causation also between, their reputation and other events that had happened in the past. And so because this was, too difficult to quantify, this was something that we instead made a qualitative disclosure for them. So perhaps there's a risk that's material, but perhaps the accuracy of the methodology or the availability of the data might be low, and therefore, you don't take it forward to quantification. So what we're trying to illustrate on the slide here is that even though you have a long list of risks and opportunities that you might like to calculate, sometimes you do need to consider, how accurate your approach can be and what data you have available. And sometimes, there are risks that you might add to your quantification, at a later date. Next slide, please. So as well as considering the how, we also wanted to spend some time talking about the what in terms of what organizations should actually disclose once you've done the quantification for the scenario analysis. So also when I was in London and TCFD became part of the listing rules, that was back in 2021, a lot of my clients were really interested about, what should the disclosures actually look like? What is the rest of the market doing? How detailed should we be in our disclosures? And this was often really a board level decision. So on the left, you'll see a few different options that organizations might choose to take, with the most simple one being at the bottom, qualitative information only, and then going up to the most precise, which would be a single amount or a range. So IFRS S2 says that your scenario analysis should be commensurate with your skills, your capabilities, and also your resources. So the regulator is going to apply a different lens to you depending on the sector that you're in and also the size of your organization. So typically the expectation from the standard is that you disclose a single financial amount or range. Although IFRS S2 also notes that some risks might not be separately identifiable, or perhaps there's high uncertainty, or maybe you have not enough resources to commit to scenario analysis. So then you might go for some of those more middle options, like doing a kind of high, medium, low, but then also making sure that you're also describing the financial effects of the risks and then linking them to the line items in the financial standards that they're going to affect. And qualitative information only is no longer acceptable under the standard. And then also on the right, we've listed some of the extra information that you'll need to disclose when you are disclosing the results of your scenario analysis. So like your assumptions, your methodologies, but we'll also share the slides after this and you can come back and see more of the details of those. Next slide. And next is a topic that is particularly dear to my heart, as I was previously an accountant and a financial auditor. And this is making sure that there's connectivity between what's inside your sustainability disclosures and then what you have in your financial statements. So for example, if your climate scenario analysis says that, you have X risk and it's material and you've provided a amount or a range of that, but then you don't at all discuss it inside your financial statements, then this is going to be a red flag to your investors. So the standard IFRS S2 does directly tell preparers that you need to consider the connections between the information that you have in your disclosures and the financial statements. And they particularly discuss this in the context of some of the metrics that are required inside the metrics and targets pillar. But a lot of these metrics are ones that actually you will generate from doing your scenario analysis. So for example, we have amount or percentage of assets vulnerable to physical risk. So perhaps inside your financial statements, you should be talking about, what is the carrying value of these assets? What is the useful life of these assets? How does climate potentially affect those? Or maybe if there was an extreme weather event in the year that you're reporting, was this an impairment indicator? We've also given a couple of other examples that you can look to for other climate metrics that will affect other financial kind of disclosures, but we'll also let you have a look at those later. And also I'd say that there are quite a lot of resources in the market which also are talking about climate change and accounting and what you might discuss. So this is, potentially something that your financial auditors are going to ask you after you've done your scenario analysis. So definitely don't miss this step. And if we go on to our next section, we're going to work through a couple of examples of those calculation pathways that we talked about. So the first one that we'll cover is carbon pricing. So carbon pricing is a transition risk that is a bit more easy, perhaps, to conceptualize. So here you'll see on screen the calculation pathway for this transition risk. So the example is here that we have a company, they have a decarbonisation strategy to reduce their scope 1 and 2 emissions by 2030, and then also they have a net zero target. But also the company doesn't collect emissions data, which is split by geography. So I guess, that's the situation going into scenario analysis. So now thinking about the calculation pathway, first we have Scope 1 and 2 emissions. So you'll need this. This is obviously the operational data. You'll be taking your historical emissions, and then as you see here, we'll be applying a regional GDP growth rate, and this would be in the unmitigated scenario. So perhaps you'll calculate this carbon pricing risk, both unmitigated and then also mitigated, where you factor in your decarbonisation targets. But for the unmitigated risk, perhaps you'll use that GDP growth, which you'll get from the third-party scenario data. And then also a complexity that we mentioned is that you don't have a breakdown of the geographies that your emissions belong to. So perhaps you might use operating costs as a proxy in order to disaggregate your emissions by geography. And then next in the calculation pathway, you'll have the carbon price. So this is what you'll take from the third-party scenario data, and you'll have this carbon price per region, per year. And then lastly is the pass-through percentage for Scope 3 emissions. So because your Scope 3 emissions, the indirect emissions, and your organisation isn't directly responsible for paying this carbon price, potentially some of your suppliers might want to pass on this cost to you as their customer. So with Scope 3, often we'll set a pass-through percentage. So for example, in this one here, we've said that the pass-through percentage is 50%. So therefore, for whatever carbon pricing comes in, both your supplier and yourselves will share that cost. Great, and I'll pass to Anna to talk through another example.
Great, thanks, Alison. So in this example, we're looking at a climate-related opportunity. And for some context around the example, the company is in the industrial sector and have a established Scope 1 and 2 greenhouse gas reduction target. The company is also international and has factories and sites in different countries. And to achieve the greenhouse gas target, they have quite a robust decarbonisation roadmap. So this includes an understanding of different initiatives to reduce electricity, natural gas, fuel consumption, and planned CapEx investments for things like equipment upgrades as well. And within the roadmap, there's also key milestones and dates for initiatives and upgrades. So in terms of the calculations, the operational data, the data source from the company would be the initiatives, the associated energy or fuel consumption, the site of implementation, and when the savings will start to occur as well. In terms of scenario data, is the cost of the energy or fuel in different countries over scenarios and time horizons. So likely using some of the databases that Alison mentioned, like NGFS or IEA. You might also have to do a conversion of units at this stage to get the operational data to match the scenario data. And then the calculation is just multiplying the consumption data by the energy or fuel costs. But something that's important to note, in some cases, the cost savings may be from the reduction or fuel consumption do come with an upfront cost. So minusing the CapEx cost from the calculation would provide the overall savings. And some assumptions may be worth noting. The cost calculations would start from the specific year the consumption savings would occur and thereafter. And perhaps depending on the energy or fuel that the company is using, the scenario data might not be available. So you could use perhaps secondary energy sources pricing data as a proxy for that as well. And we just wanted to quickly showcase that although one calculation might seem quite simple, when you have lots of different countries or regions or different operational and scenario data, this can all build up. So when we work with companies, we develop a calculation tool where we have the back calculation tabs that have all the detailed working and the methodologies, so pulling through the operational data, scenario data to calculate the individual risk or opportunity where the cost may occur either by region or business unit. And then on the summary tab, we've got the financial impact of the risks and opportunity under scenarios and time horizons, including both that mitigated and unmitigated costs as well. And then this is also where we would start to consider linking to some of the financial metrics as well. And when we develop this tool, it is automated so that there are any changes to the scenario data or operational data, then those can be changed and the calculation updated as those changes might occur. We are at time, so it doesn't leave us much time for any questions, but we have noted there are a couple that have come in, so we will follow up on these questions. I think one of the main ones is, will the slides be shared? So the recording will be shared as well as the slide deck as well, so we can send that to everyone that attended. And then just a final note, next week we do have the part 2, so please do also join us next week for the webinar on focusing on the physical risks as well. But that is us at time, so thank you very much for joining, everyone. I hope you found the session useful, and we'll follow up on those questions as well.